Hey, what's up everyone? My name is Scott and welcome to my channel where I'm here to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And my goal in this video is to help make your life a bit easier by showing you how you can introduce some automation into your option trading strategy. And no, I'm not talking about paying for a trading bot to trade for you and lose money in the process. I'm specifically referring to taking advantage of a few key features that most trading platforms offer to quite literally help you automate certain aspects of your trading strategy. And specifically, I'm referring to limit orders, stop limit orders, and alerts. And so in this video, I'm going to show you how I use all three of these things to automate my profit taking for all my positions, how I automate my adjustments for any losing positions I may have, and then finally how I set up my automatic notifications to tell me when I do actually need to step in and manually take some sort of action. And in this way, using all three of these different methods, it allows me to not have to watch my trading platform every second of every day. In fact, most of the time, I do my trading in the morning, about 30 minutes to an hour, and once I'm done, I pretty much just push my laptop off to the side and work on something else. And finally, as always, before we get started here, in case you are brand new to the channel, I just want to let you know that you can also find me on SKILLSHARE as well, where you can take my very in-depth classes on options trading and stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out. And when you sign up for SKILLSHARE using any of those links, you'll get a full 1-month free trial. And so with that being said, let's jump on over to my computer now and we'll get things started. Okay, let's get started here. Now for all the different methods I'll be showing you in this video, the different ways to automate your trading, I'll be focusing on Alibaba, which is BABA, as my main example. And the reason being is I currently have a position on the stock, and so therefore I can show you exactly how I personally use all three of these different methods. So starting off first with automatic closing orders, let's go to the trade tab now, and here you can see the exact position I have on the stock. In particular, within the October expiration cycle, I am short a naked strangle, which is simply selling an out-of-the-money call option and also an out-of-the-money put option. And so, of course, the idea here with this kind of position is by the expiration date in 27 days or sometime before that, I want to buy these options back for a much lower price. So initially, I sold this strangle for about $700 in credit, and I typically like to buy my options back for half price. So that means if I sold this strangle for $700, I'm then looking to buy these options back for a total debit of $350, half of the initial $700. And therefore that would leave me with a net profit of $350. Now with my position set up as is, I currently do not have any automatic closing orders on this trade right now. So at the moment, if I did want to buy these options back at my personal profit target, I would have no choice but to sit here and watch this position fluctuate on a day-to-day basis. Right, in particular, I could come to the monitor tab, and then down here you can see my Alibaba position under the short strangle category, and I could just monitor this P&L open column. This will tell me by how much I'm either above water or below water on this position. So at the moment, I'm up on this Alibaba strangle by about $176. So I need to wait for this position to become more profitable by an additional $175-ish before my profit target is reached. And again, at the moment, I would have no choice but to sit here every day and watch this position and wait for the P&L open value to hit my profit target. I don't want to do that. As much as I love trading and being involved in the market, there is no way I'm willing to just sit here for hours and hours every day and watch all my positions super carefully. So this is where automatic closing orders become extremely useful. And so in this case, I can just go down to my 190 strike call option, right click, and go to buy, because again, I want to buy these options back to close this trade. And then I can go to strangle, and that brings up the order down here to buy it back. So as you can see, buy one contract, 190 strike call, and then buy one contract. It's going to be the 150 strike put option. There we go. And then over here with the limit price, I can just set the price at which I want to buy back this entire position, which as I explained earlier is $350. Or $3.50 on a per share basis. Again, keep in mind, these option contracts are tied to 100 shares each. And then finally, I just have to make this a GTC order, good till cancel, which means this order will always be in place until I either come in and cancel it myself, or it does get triggered and it closes down my entire strangle for a nice profit. Otherwise, if this was just a day order, it would simply expire once the market closes on the next trading day. and therefore every day I would have to recreate this order. So again, just make it a GTC order and save yourself a lot of time. And once that's done, I just go to confirm and send again, and boom, all done. Now I don't have to monitor this position super carefully every day. Once the combined value of these two option contracts fall enough, specifically down to a value of 350 bucks, that order will get triggered. I'll get a notification on my laptop here and also on my phone saying, hey, you are now out of your Alibaba short strangle. Now, next up, I want to talk about automatic adjustment orders. So especially with options here, there's a lot of different ways you can manage and adjust an existing position. And the way that I personally do it, which has been working extremely well, is I either buy or short shares of the underlying stock, Alibaba in this case, if one of my options gets breached. So for example, if my call option gets breached, if the price of Alibaba currently at 160 goes all the way to and above 190, I will buy 100 shares of this stock. And in doing so, I will have converted this initially naked short call option into a cover call option, in which case it does not matter how much higher Alibaba goes after that, right? Because when you sell a call option, you as the seller are obligated to sell 100 shares of the stock at the strike price should this option be in the money by the expiration date. So if Alibaba does have a massive explosion to the upside and it blows through my call strike, but I buy the shares right around 190, then let's say by October 15th, the expiration day, this stock ends up all the way to 220. And so in this scenario, it's no big deal, right? Because again, I will have purchased the shares right around 190 ahead of time, and now I'll have to sell them at 190 once again. So the net result is I don't make or lose any money on the stock, but I still keep the credit, the premium I sold the call option for. That's my profit. And the same concept applies to the put option side. If Alibaba tanks in price and blows through my put strike at 150, I will just short 100 shares of the stock. And again, that will totally cover my obligations on the short put option such that no matter how far the stock falls, I won't make or lose any money on the stock, but I'll still keep the premium I sold the put for. That's my profit. And then of course, just to paint the full picture here, if the stock just remains in between my strikes, above 150 and below 190, then by the expiration date, these options will expire worthless, or actually my automatic closing order will kick in at some point before then and buy these contracts back for a much lower price. And I will not have to make any adjustments. But that's the ideal scenario though. And in trading, you must always be prepared for the worst case scenario. Now, unfortunately, if I was managing this position completely manually by hand, I would also have no choice but to watch this position extremely carefully, tick by tick, every single day. Because my entire approach behind managing this kind of position is I have to make sure I either short or buy the shares of stock right at my strike price, as close as possible. So that's one issue. The second one also is, let's say for example, Alibaba blows through my call strike, and in which case I'll have bought the shares as close to 190 as possible. But now what happens if the stock does actually reverse and goes back down below my call strike? In this situation, I'll have to get rid of those shares as quickly as possible, again selling them as close to 190 as possible. So to reiterate here, if I was doing this stuff manually, I would have no choice but to be glued to my screen watching the price of Alibaba move around tick by tick, especially when it gets close to 190 or 150, and be ready to buy or sell the shares at exactly the right prices. And also keep in mind, I do have many other positions on too, and there could be more than one position that is very close to one of my strikes. And there's just no way I could simultaneously watch the stock price of different stocks that closely all at once. So how can I solve this problem? And the solution is actually pretty straightforward. I can set up a chain reaction of orders that will be in place all the time that will only get triggered at the exact prices that I specify. So continuing my example here with a call option, I want to have an order in place that will buy 100 shares of the stock should it cross 190. So I can go up here, click on the price of Alibaba, and just go to buy. And by default, that brings up an order to purchase 100 shares of stock, but I will have to change the order type. Specifically, we'll go to a stop limit order. And with stop limit orders, there are two prices that you must keep in mind. There's the stop price and the limit price. Now, the stop price is simply the price at which this order, once the stock crosses that price, this order will now become active. So in my case here with Alibaba, let's say I want this order to become activated once the stock reaches a price of 190.50. And you'll see why in a second I'm choosing this price and not 190 exactly. But again, should Alibaba reach a price of $190.50 per share, this order will now become active and try to purchase 100 shares of the stock. Now the limit price is the highest price I'm willing to pay to buy these shares. And so of course, intuitively, it must be greater than your stop price. And so for this one, I can just put 200 for example. So now the full picture here is again, should this stock reach a price of 190.50, this order here will immediately become active and try to purchase the shares as close to 190.50 as possible. This 200 here is simply the ceiling, the highest price at which I'm willing to buy the shares at. And there is no real reason as to why I specifically chose 200. I just want to give this order here some room between the stop and limit prices such that if Alibaba does move quickly and perhaps gaps over the 190.50 stop price I have set, maybe on the market open one morning, the stock opens at 191 or 192, then this order will still work. It will still try to buy the shares for the lowest price possible as long as the stock is above my stop price. That's it. And then the final step here is to make this a GTC order so that it's always in place until I either cancel it or it does get triggered. But this is still only half the equation, right? This order will only buy the shares of stock. But going back to my earlier explanation, what happens if the stock does actually reverse? Well, to accommodate for that situation, I can go down here under the advanced order type option. Right now, it's just a single order, just this one stop limit order, but I can change this and make it a first trigger sequential order. Now, what does this mean? It simply means that any additional orders I add to this package here, if you will, this package of orders you're about to see, then they will only be looked at and executed sequentially, one after another. So in the case, if Alibaba does reverse, let's go up here and now click on the sell order. Boom, that brings up the sell order down here. Again, selling 100 shares of the stock. We'll have to make this a stop limit order as well. And so now for this one, I want this order to become active after this order gets filled, if it ever does. And then also, if the stock price does drop back down to, let's say, 190 exactly. And then for the limit price, I'll set this to 180. This is now the lowest price at which I'm willing to sell the shares, should the stock actually reverse. And so just to explain once more, this second order, this sell order, will not even be considered until this buy order actually does get executed and filled. That's what the first trigger sequential advanced order type means. It's simply going to execute all the orders that are listed here sequentially. So this one here in green will buy the shares if Alibaba does ever cross 190.50. And should the stock keep on going higher, then great, doesn't matter. Because now this short naked call option is converted into a cover call option. But if the stock does reverse and goes back down below 190, then this sell order will become active and it will sell the shares for the highest price possible once the price reaches 190 exactly. And ultimately, if both these orders were to get executed, I would lose $50 in the best case, right? Because if I buy the shares at 190.50 and sell them at 190, that's a loss of 50 cents per share times the full 100 shares. That's an overall loss of just $50. And if my total credit on this entire short strangle is about 700, then losing 50 is not a big deal. And the very cool thing with this kind of order type, this first trigger sequential, is I can add more of these kinds of orders. Because in my experience, this kind of thing definitely can and will happen multiple times in the same trading day. You'll buy the shares at 190.50, then sell them at 190, then the stock might reverse and go higher again, so you'll have to buy the shares once more. Then the stock might reverse and go back down lower, so you have to sell the shares, so on and so forth. Right now, this only takes care of one cycle of the stock going higher and then lower below my strike. So all I have to do is go back up to the price and click on the buy order again, and boom, that adds another buy order down here below. Again, make it a stop limit order, and we'll choose the same exact stop price and same exact limit price as the earlier one. So the stop price will be 190.50 and the limit price will be 200 again. And then once more, go back up here, click on sell. That adds a new sell order. Make it a stop limit. And then down here, set the stop price to 190 and the limit price to 180 and so on and so forth. And oops, one thing I did forget is I do have to make all these orders GTC orders as well. You cannot have a mix of day orders and GTC orders. So now with this whole thing, this takes care of 2 cycles of the stock potentially crossing my call strike, then going back down lower, then crossing it again, and then going back down lower once more. And I can still add even more orders to this chain here, all the way up to, I believe, 8 orders in total. So basically I can double what I already have here. And of course, I can set up the same exact kind of thing for my put option as well. The main difference, of course, is instead of the first order being to buy 100 shares of stock, the first order would be to short 100 shares of stock. And then I would buy them back, short them again, buy them back, so on and so forth. It would just be the opposite. Now, do also keep in mind that this is simply my personal use case. This is how I adjust my option trading strategies. You definitely can change the number of shares that you want to either buy or sell. You can change your prices, either your stop or your limit prices. And of course, you can also use this for option buying strategies too. For example, if instead of selling this entire short strangle, maybe I just bought an in-the-money call option, perhaps the 150 strike call. And then one way I could hedge or adjust that position is if the stock does reverse and start to go lower, I can start shorting shares of the stock. Or in the case if I was bearish on Alibaba and I just bought an in-the-money put option, or any put option for that matter, if the stock did start to increase in price and I was just wrong, I could start buying shares of the stock to hedge this put option. And I could use this same kind of advanced order type to do just that and make it automated. However, I will say this is probably best used for option selling strategies because, as I explained, when these orders do get triggered, I will lose a small amount of money each time, $50 in this case. And for option selling strategies, I can use the credit I received from putting on that position to compensate for these small losses. Whereas for option buying strategies, you paid money initially to get into the position, and so as a result, there's no way you can compensate for losing money on any of your stock hedging. So with that being said, let's go to confirm and send here and fire off this order. Boom, all done. And then finally in this video, the last thing I want to mention in terms of ways you can automate your trading, and that is to use alerts. So in my case here with this short strangle, as you saw, I currently have a hedging order in place to buy and sell stock should Alibaba increase to above 190. But I don't have any orders on the put side. And unfortunately, I'm not allowed with ThinkOrSwim to have a buy order and a short order for the same stock in place at the same time. So basically, I can't have orders to buy the stock at 190 and also at the same time have orders in place to short the stock at 150. I can only have one of those kinds of orders in place at one time. So of course that means once again, if I was doing this manually, I'll have to sit here and watch this stock to see if it starts to drop in price and begins to get very, very close to my put strike, in which case I'll have to cancel all my buying orders up here and put in place some new short selling orders. So how can I automate that to some degree? And the answer is simply to use alerts that will notify me if the stock does start to get close to my put strike. So I can right click anywhere on the option chain and go to create alert. And the cool thing is there's actually a lot of different ways and metrics that you can create alerts on. I'll show you those in a second. But in this case, I want to just be alerted if the stock price, if BABA stock reaches, let's say 155. Right now the stock is at 160. So if it does drop down to 155, which would put the stock about or exactly $5 away from my put strike, then let me know. And if that happens, I'll have plenty of time to go into my platform here, cancel my buy orders, and then put in place my short sell orders. So I'll go ahead and click create on this one. And also if I go to the charts real quick, you can see that alert right here on the price action chart. And you can also see some information about my buy orders that are in place as well. And so then let's say this stock does actually drop down to 155, in which case I'll get notified, I'll cancel my buy orders, put in place my short sell orders, great. All that's done. Now what? The last piece is to set up one more alert that will notify me if the stock totally reverses and now starts to get closer and closer to my call strike at around 190. So in a very similar fashion with this alert here, I would just make a new one with a price a few bucks below my short call strike. And in that case, I would have plenty of time to go into my platform, cancel my short sell orders, put in place my buy orders, and then recreate this same exact alert down here once again. And just repeat the process back and forth, and follow the stock. And so using all three of these different methods, my automatic profit taking orders, automatic adjustment orders, and then also my alerts, these three things combined pretty much allow me to go about my day without having to closely monitor my platform here for much time at all. Now, lastly, one final thing I want to show you in this video. As I mentioned, you can create alerts on a lot of different things. And so by default in ThinkOrSwim, when you create an alert just like this, it's already set to notify you based on the price of the exact option that you clicked on. So for this one here, because I clicked on the 150 strike put, you can see it right here. And the current mark price is $4.30 on a per share basis. And I can change this number to anything I want. For example, if the value of this put doubles in price and goes to $8.60, then let me know, right? If the mark price of this option is at or above $8.60, send me a notification. Or if it gets cut in half and falls down to $2.15, then also let me know. And you can see automatically it's switched to notify me if the mark price is at or below $2.15. So that's very nice for other kinds of adjustments that you may want to make on your positions or what have you. You can also set alerts based on an entire position. So for example, if I wanted to get notified if the entire value of my strangle, specifically if we go in here and change the strikes, so October expiration cycle, that's correct. And my strangle is at the 150 strike put right there, and then the 190 strike call, which is right here. So great, now this alert will monitor the value of this entire position, this short strangle that I have on, and it will notify me if the value of this whole position reaches a certain number. Perhaps in my case, if the value falls down to $3.50, half of the original price that I sold it for. And also one more thing I'll show you with these alerts, I can even get more detailed into what the alerts are monitoring. So I just switched it back to a single call option, the 160 strike call. And so far, all these alerts have been based on the prices, the mark prices of these options. But what if I wanted to create a notification based on the delta of the contract? Not the price, the delta. So perhaps if the delta of the 160 strike call reaches maybe 70, and therefore it's now pretty far in the money, maybe at that point I want to make an adjustment, or take my profits, or cut my losses, whatever. It's totally up to you how you want to leverage these kinds of alerts, but they are super, super helpful, and you should definitely take advantage of them. And so with that being said, that's going to conclude this video. I hope you enjoyed it, and please let me know your thoughts, or if you've got questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading and stock market investing, then check out my SKILLSHARE courses. Links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.